Welcome to our H2 Market Outlook. My name is Steve Brice and I'm the bank's Chief Investment Strategist. Key challenge facing investors is finding strong sources of potential return in an environment where equity markets are fully valued and interest rates are low and in some cases negative. This is complicated by the fact that the US is in the late stages of its economic cycle, China is trying to avoid a hard landing, and we're seeing rising political risks in Europe. Against this backdrop, we would balance a multi-asset income approach with global macro strategy investments. There are always upside and downside risks for equity markets. On the positive side, the worst of the earnings recession appears to be behind us. However, equity markets appear fully valued, and the US is in the late stages of its cycle. While a recession is not the most likely outcome over the next 12 months, the probabilities of a recession are rising over time. Against this backdrop, we prefer to err on the side of caution, trimming exposure to equities and also focusing on the more defensive areas of the market. That said, we would maintain an allocation to equities. There is the risk that we'll see equity markets do well on the back of reduced interest rate hike expectations in the US and that earnings recovery that's expected in the second half of the year. Brexit is symptomatic of a rising distrust of economic and political elite. We're seeing these trends across the world, whether you're looking at the US or elsewhere in Europe as well. This just reinforces our preference for dialing back risk in investment allocations. From a euro area equity perspective, the fundamentals are actually still quite positive. Growth is holding up, inflation is benign, and that's allowing the central bank to keep monetary policy very loose. All of this backdrop should allow earnings to recover as we go through the second half of the year. However, the political risk premium has increased, which means a re-rating of euro area equities that we had expected may be delayed. Hence, we've reduced our allocation to euro area equities in favour of US equities. The key here is the growth differential between emerging markets and developed markets, whether it be GDP growth or earnings growth. China stimulated the economy very sharply in the first quarter, but then withdrew that stimulus in Q2. So we're not convinced that we're actually going to see that growth differential widen in favour of emerging markets just yet. There are risks to this view. If currencies in emerging markets strengthen massively, that would allow central banks to ease monetary policy, boosting growth. We're not there yet, but we're watching it closely. China's key policy objective is to reduce the economy's reliance on debt financing. On this, it is important for them to stimulate nominal GDP growth, whether it be through real GDP growth, i.e. value added to the economy, or inflation. A weaker Chinese renminbi therefore makes total sense for the authorities, as it helps boost exports and therefore real GDP, but also helps import inflation to a limited extent. And we expect the Chinese renminbi to weaken gradually over the coming 6 to 12 months. So a weaker CNY remains a risk for global financial markets, but we do think it's mitigated by the fact that markets now have a greater understanding of what the Chinese authorities are trying to achieve. Thank you for joining us.